Hello everyone, welcome to Atomic ACCA's pre-mock exam solving series, and in this video we are going to look at section C question number 1 of Financial Management March 2025 exam. So section C, as we know, we have two case studies over here. Generally these will be around investment appraisal, working capital management, or business finance. So any two out of these three topics is generally tested within section C, and it will be consisting both numerical and as well as theory question. So let's look at question number 1. So the question is, for the proposed investment in the new store, calculate the following: NPV for 5 marks, IRR for 2 marks, payback period for 1 mark, and ROCE based on the average investment method, and that is for 2 marks. All right. So that's all numericals, and that's totally worth 5 plus 2, 7, 1, 8, 2, 10 marks. Okay. This scenario relates to 5 requirements. Okay. Nunda Stores is a community-based supermarket that works with local suppliers to bring their produce to market. It is expanding its operation and is considering setting up 10 stores in the south of its country. Directors are concerned that payback on this investment will be a long period, but are confident that the expansion will be profitable and will show a positive return to shareholder. Directors normally have a target payback period of 2.5 years and a target return on capital employed for 25% for the investment. Finance director has suggested she provides NPV and IRR calculations for the investment. This will enable all the directors to see a full picture of the investment's potential financial acceptability. Okay. This expansion will cost 330 million paid at the start of first year, so at T0. As reinvestment in store will be required every 4 years, company evaluates investment over a 4-year time horizon, so T1 to T4, and assumes a nil realizable value, so no scrap value. Working capital should be ignored as this is a cash rich business with a negative cash operating cycle. Nanda Stores has prepared the following forecast of contribution and incremental fixed cost at current prices, so we have to inflate it, of the 10 store program over 4 years. Inflation is estimated to be 4% on contribution and 3% on fixed cost. So we're given with contribution at 4%, 3% on fixed cost. Okay. Then Nanda pays corporation tax of 20% per year, 1 year in arrear, so taxes in arrear, with 25% straight line tax allowable depreciation available on the investment expenditure. So investment expenditure is 330 million, and on that 4-year straight line depreciation we have to do and multiply it by the 25 percentage, we have to get the figure. Okay, so that is all right. Then Nanda currently uses 10% as the nominal after tax discount rate to appraise investments. All right. So first we have to calculate the NPV. So we'll just write over here. This is A1, which is net present value. Now, how to calculate net present value? First, we need the time horizon T0, T1, T2, T3, T4, and we'll have contribution, and we have to minus out fixed cost. So I'll just pull all this to one more column. Okay. Contribution, fixed cost, and no other cash flows are given. So we can assume that after this, we are going to get the taxable cash flows. Then on that, we have to pay tax. Then it was shown that some tax allowable depreciation is there, some tax benefits we are going to get. Then we will get the post tax cash flows. Then we have to take the non-taxable cash flow. So we'll start with initial investment. They told working capital is not needed, scrap value is not there, so we will get after this the the net cash flows. Then we will take the discount factor. What was discount factor? Discount factor was 10%. So on 10% we'll find discount factor, then we'll find the present value, we'll sum this up, we'll get the NPV. So this is how our layout will look like. Now first is contribution. The figures given are 80, then it is given 160, and it is given 180, and it is given, oh, it's not a T0, it's T1, so we'll just pull this one side. So then T4 is given 200. Now they have told that all these are in current terms, so we have to inflate it. What is the inflation rate for contribution? 4% on contribution. So this will be equal to into 1.04, this will be into 1.04 raised to 2, this will be equal to into 1.04 raised to 3, and this will be equal to 200 into 1.04 raised to 4. So we got all the figures now. Similarly, now we have to take for fixed cost. What is fixed cost given? 50, 50, 50, 50. So here it will be 50 into what is the rate into 1.03. 3% on fixed cost just. So 50 into 1.03. Now here it will be 50 into 1.03 raised to 2. 3% on fixed cost. Okay, 50 into 1.03. Okay, next one is again 50 into 1.03 raised to 3, and last one is equal to 50 into 1.04 raised to 4. So we have all the fixed cost also ready. So 15, this is 1.04, 1.04 into 2, 1.04 into 3, 1.04 into 4, and 80, 160, 180, and 200. Okay, this one is 15 to 1.03, 15 to 1.03 raised to 2, 15 to 1.03 raised to 3, 15 to 1.03. Okay, 03 raised to 4. So it's always good to have a recheck over your numbers. Make sure that you're not making a mistake, because if one mistake happens, that fixed cost mark you will lose. That one line only. Definitely the numbers that comes after that you will get marks, but still you will lose marks over here just for one careless mistake. So be careful on that. So taxable cash flows here would be equal to this one minus the fixed cost, and I'll just copy paste this for all of this. So we got the taxable cash flow. Tax, they told it is in 20%, but in arrear, so we are supposed to have one more column over here, and it will be like this, equal to minus this one multiplied by 20%. So 1 year forward it will be same thing. I'll just copy paste for all the years, so that is sorted. Then we need tax benefit. Tax benefit, we can just, I'll just calculate over here, tax benefit working note. So investment amount was 330 million. Tax allowable depreciation is available for 25% straight line method. That means first on the cost you will multiply with 25%. So that is basically divided by 4. So whatever answer you get, that depreciation will follow for 4 years. So that depreciation multiplied by the 20% tax rate, we will get the tax benefit amount. So this one into 25% will be the depreciation amount, and the tax benefit will be equal to this one into 0.2. So that is 16.5. Because it's a straight line method, depreciation every year will be same, so tax benefit every year is same. So tax benefit is equal to 16.5. Next year also 16.5. Next year also 16.5. Next year also 16.5. So can we just write 16.5 and copy paste? Yes, you're allowed, but I just connected over there so that, because I wrote it to the right side. So when the examiner looks at my solution, they'll get to know that I didn't bluff this answer. I got this answer from a working note, and they can simply go and see how did I calculate it. So to connect that particular working note, I connected the cell. Now, post-tax cash flows will be equal to the sum of, I'll take the sum of everything because I put a negative sign for these. So I can just sum it up. Same thing, I'll copy paste for all the years. So I'll get all the numbers that are required. So tax is ready. Tax benefit is ready. Taxable cash flow. Okay. Initial investment at the beginning year, we need to invest 330 million. So that is in T0, that is ready. Then net cash flow will be equal to the sum of, I'll just take everything from post-tax cash flows, copy, paste it for all the years. So we have the net cash flow, discount factor at 10%. In T0, it will be equal to 1. In T1, it will be 1 divided by 1.10. And I can copy paste this for all the years. Or you can use your discount factor table and get the number. Anything is fine. That table you can find over here. Formula sheet, FM formula sheet, click on that. And if you scroll down, you have your discount factor table. So you can just have a cross check over here. First is 0.909826,751, 0.683, 0.621. So we have all our numbers ready through the formula. So that seems little more faster than copying from the table. So I stick to it. But keep in mind, section A and B, don't use the formula, stick to the table and find the answers because it's computer corrected. For section C, it is human corrected. So the examiner can get an understanding of how you got the answer over here. It's through a formula. Definitely the formula and the discount factor table numbers slightly will be different, and the final answer also will be slightly different due to rounding of difference, but that is totally fine within your section C questions. Finally, the present value will be equal to net cash flow into the present discount factor. Copy paste it for all the years, and finally NPV will be equal to the sum of all these numbers. Now, instead of doing this step, you are allowed to use your NPV Excel formula as well in order to get to the answer. That is also fine. You will get marks for that. So we are done with our first calculation, that is for NPV. So I'll just mark it over here. This is the NPV calculation. So the answer is 12.45 million. I'll just write over here, million. So that is over. Next thing is we have to calculate the IRR. So this is part of A2, internal rate of return. Now for IRR also there's an Excel formula, you can do that, but I stick to always the traditional way, so I'll do that. We have at 10% a positive NPV, so NL and L is available. Now I have to find a higher rate and NH. So what I'll do, I'll take the cash flows, I'll just copy paste these numbers, all the cash flows I'll take down, and I'll find a higher rate. Let's take discount factor at maybe 15%. That's generally what we always do. Equals to 1 equals to divide by 1.15, and I copy paste this entire thing for all the years, and this didn't come out properly. Equal to this one, copy paste it for, okay, now the formulas are okay. Minus 19, 16, okay, fine. So the present value will be equal to this one multiplied by this one, and I copy paste it for all the years. And if I take the NPV over here, that will be equal to the sum of all these numbers. And now we have a negative NPV. Now we have H, NH, L, NL. So what is the IRR formula? IRR formula is L plus bracket open NL divided by NL minus NH. Now since NH is anyways a negative figure, it will be like NL minus 27. So it will turn out to be a plus figure anyways. Then multiplied by H minus L. So this will be the formula. Now let's apply this. Let's first type equals to, where is L? Lower rate is, okay, I didn't write it anyway. So L is 10, that is 10%, plus NL is NPV at lower rate, that is this one, divided by NPV at lower rate, plus minus NH bracket close into H is 15 minus L 10. So I'll just put all of this inside one bracket and then add it with the 10. Why is this not correct? D20 is 12.45, then NL D20 minus 28. Let's put the percentage sign, maybe that's why. 15 percentage and 10 percentage. Discount factor is 10%, so IRR is not going to be 1.5 percentage. What else could be the reason for this? Okay, let's put a bracket for the denominator and see. No, still not coming through. Let's break this down. 10 percentage plus NL was 12.45 divided by 12.45 minus 27, so that's going to be plus 27. Then okay, let's put this inside one bracket. Then let's put all of this inside one bracket into H minus L. H is 15 percentage minus L is 10 percentage. Let's put all of this inside one more bracket. Okay, now this looks like the numbers, so let's copy paste it down and see. Let's hope this turns out to be correct. Okay, no, it's fine. So same thing I typed over here also, but I don't know what went wrong. Okay, whatever. So let's remove this thing. How do I know this one is the correct answer? Because our discount factor is 10 percentage. So IRR is supposed to be something greater than this, because at 10 percentage we found a positive NPV. So whatever IRR comes up, it's supposed to be greater than 10 and definitely not less than that. Some error in the numerical or maybe in the formula that I took up, it was showing first 1%, then first it was showing 105%. That definitely is not the answer, because at 15% it became negative. So it's something in between 10 and 15. Second time when I did some bracket arrangement, it showed 1.5. Then it showed something 6%. All of this is less than 10%. That's why I was sure that that was a wrong answer. But now we got an answer that is 11.57%. So that's between 10 and 15. So this one is supposed to be the figure. So I'll just copy paste it here. If I click the percentage button, will this come out correct? Okay, 11.6%. So that is also ready. So IRR is done and NPV is also done. Okay. Next one was payback period. So A3. Now you can avoid all this hassle. Okay, you can use the IRR formula in order to get that answer. So still it is fine. The Excel formula, you will still get the full marks for that. Then A3 is payback period. How to get the payback period? We have to take the net cash flows, then see when am I getting the initial payback. I mean initial investment back. So at I'll just copy paste the timeline from here. Then the cash flows are, we'll copy paste it from T0. The cash flow is minus 330. Then we have the cash flows for all these years. So these cash flows we took, the net cash flows. Now we have to see at what point am I getting my initial returns back. How much I have to get? 330. So let's start counting. First year I get only 31.7, so not yet there. Next year I get 31.7 plus this one, so I have 161, not yet there. Then I get, now I have 161 altogether plus 140. I reach 302, so not yet there. Now 302 plus 164, I reached 466, but I needed only 330. That means at T3 I'm not getting it, but at T4 I'm getting more than what I need. So in between T3 and T4 is my time period. So it's going to be 3 point something years. How do I get that? At this point, how much did I get? 302. How much more do I need in order to balance out? I need 330 minus this one. That means I need 27.79 more in order to reach to that zero. Now I need to find a proportion. How will I find the proportion? I need only 27.79. But in that next following year, how much am I getting? 164.62. That means 27.79 divided by 164.62 multiplied by 100 will give me the answer 16.88. That means it takes 16.88 or like 0.1688, that much amount of percentage from the T4 in order to get my answer. So if I round this off, because I have to add the three years also on top of that, I'll just round it off, or let's remove that 100. So we have the decimal figure 0.166. So initial 3 years and a 0.16 year from the T4 will give me my payback period. So payback period is equal to 3 plus 0.168. So this much years it will take. And that is my solution for this particular question. That's why payback period question had only 1 mark. And finally we have the A4 question. A4. A4 was asking for return on capital employed based on average investment period. What is the formula for average ROC? I need average profit divided by average investment. Now, first thing is I need to find out profit. So far we were calculating on the basis of cash flow. Now, this profit is after tax or before tax. If you remember from the calculations, either from FM or if you remember the format back in FR, what we learned, it's generally PBIT or the PBT that we have to use, not the profit after tax. So, anyways, this figure is going to be, okay, let's write average PBIT. Okay, average PBIT by average investment. Anyways, nothing about interest is mentioned over here, but about tax it is mentioned. We took tax cash flows, we took the tax benefit also. Now we need the profit before this. So what we can take is, first we can take the cash flow before tax, meaning the taxable cash flows. That is equal to, if we go on the top, we have the taxable cash flows as 31.7. Then if we copy paste for all the years, last nothing is there, so that we can remove. So these four are the cash flows we have before tax. Then what happens? This is cash flow. We took depreciation and we found out the tax benefit out of it, but that is cash flow calculation. If I need a profit, if I want to move from cash flows to profit, what I have to do? I have to minus out this non-cash expense, which is depreciation. So if I deduct depreciation, how much is the depreciation figure? Depreciation figure is 300. Somewhere it was there before, we already calculated. How much was it? I will just do it once again. 330 divided by, no, into 25 percentage was the allowed depreciation. So 82.5. So if I take it for all the years, now we have 82.5 across all the years. Now the profit will be equal to this one minus this one. So we have first year loss, then all the years we have profit. Now if I take an average of all this, because we need average profit, so if I take an average profit, it will be equal to the sum of all these profit figures divided by 4, because this profit is over 4 years, so average means I need to divide it by 4. So on an average I will have 36.811, this much figure, average profit. Now I need to find out the average investment. What is the average investment formula? It is equal to the initial investment plus scrap value. Now scrap value anyways is 0 over here, so plus 0 or minus 0, whatever, divided by what is it, divided by life, no, not life, divided by 2. So initial investment divided by 2 will give me the answer for average investment. How much is the initial investment? 330 by 2 will be equal to 165. So we got the average investment as well. Now if I want to find what is the average ROC, it will be equal to average profit divided by average investment. That came out to be 0.22. So if I make it into percentage, it will be 22.3 percentage, and that will be our final answer over here. With that, we have found out our four answers, and our 10-mark question over here is completed. All right, now let's move to question number 2 over here, because this is a 20-mark case study. Question number 2 is asking, discuss the suitability of the techniques used in A for determining whether to undertake an investment, and advise whether Nanda Store proposed investment is financially acceptable. So that's for 10 marks. Now, when you see a 10-mark theory question, don't right away start thinking that okay, we have to write big paragraphs in order to score these marks. Rather, start breaking the requirement into part by part. How we have to do that? First and foremost thing, we have to always be careful with the conjunctions used in the requirement. Conjunction means connecting words. So, discuss the suitability of techniques used in part A for determining whether to undertake an investment, and and advise whether Nanda Store's proposed investment is financially acceptable. So this and is very important, because mostly people will think that okay, we have to discuss the techniques used over there. So you start writing the techniques, big paragraphs are there, and 10 marks you fill in, but forget to end up advising them. You forget to address this part. So even if you have 10 marks worth of discussion that you have put and you have not advised what is the best one, then you will not score marks for whatever allocation is over here. So first and foremost thing, you have to address every requirement. Second thing, now how we are going to split it. In requirement number A, we talked about four different things: NPV, IRR, payback, ROC. So four things are there. And up after discussing about these four things, we have to advise as well. So if I give 1 to 2 marks for this advice part, then there is 8 to 9 marks to score for the discussion part over here. Next thing, I have to split it across four different items. So roughly speaking, I need to give around 2.5 mark for each discussion. So now I got a rough split. So for that 2 marks, I just need maybe 2 to 3 sentences in order to score that 2 to 3 valid points. Next thing, when I am discussing the suitability, I have to tell about how good it is, how bad it is as well, which means I can talk about some advantages. I can talk about some disadvantages as well in order to finalize my answer. So when I talk about one advantage, one disadvantage, or maybe one or two items, I will get enough information for one particular investment technique. Similarly, if I do for four techniques, few advantage, few disadvantage, I can easily score that 8 to 9 marks over here. This is how you have to split your marks and structure your answer before going and writing out all the points. Now, since we have to say whether this is financially acceptable or not, we have to take all the answers, that final answer from the previous question, and bring it up. So since we can't see it over here, we'll do one thing. We'll go to that question, copy paste everything into the scratch pad, the final answers, then come to this question so that we can easily do all the final answers over here rather than keeping on switching one by one. So we can take the scratch pad and write down the answers. We're doing question number 31. Answers are for NPV, it was 12.45 million. IRR was 11.6%. IRR is equal to 11.6 percentage. Payback period was 3.17 years. Payback is 3.17 years. And finally, average ROC is 22.3 percentage. Okay, so we got all the information ready. So okay, we have all the figures ready over here. So now let's start talking about each element in this one by one. Okay, so first we are going to discuss about NPV method. NPV. So what can we say about NPV? The net present value is an investment appraisal technique that theoretically stands superior to all other technique. What else can I say? The final answer that we get is an absolute measure because it's an absolute amount. So the value obtained as NPV is an absolute measure of shareholder wealth creation. So we wrote one advantage. We can write one more, or we can write easy ones if you have. The NPV method considers whole life of the project. One more advantage, and also the time value of money by considering the present value of all future cash flows. So we basically wrote three positive points over here. Now we can write one negative as well. However, NPV is based on many assumptions behind it. What assumptions are there? Let's take few of it. One we used, let's say in the calculation we used, contribution and fixed cost had fixed inflation rate for all the years. Tax rate was constant every year. Working capital was ignored. So that's good enough points. Discount factor is considered constant every year. So we can just assume, take that constant figures and consider over here. So we can say over here that the, for example, NPV is based on many assumptions behind it. For example, tax rate and discount factor used in calculations are assumed to be constant every year. For this company itself, for Nunda Stores NPV calculation, inflation rate for contribution and fixed cost was assumed constant for all years. Done. So we told the constant cash flow is an assumption, that is a disadvantage. The now what is the, okay, we can write the financial acceptability altogether at last. So we can write the conclusions of all of this at last. Fine. First we can just discuss the suitability, whether this is good or not. So this is over. Next we have to talk about, second one was IRR method. What is IRR method? Compared to NPV, IRR method is a relative measure and not an absolute measure. So that's basically one disadvantage. Now let's say, what is IRR? IRR shows the rate at which NPV of project would fall down to 0. Next thing, what is the what is the essence of using an IRR? If my WACC is over here, current discount factor is here, and if IRR is very greater than this, that means the project will not become 0 anytime. NPV will not fall to 0 anytime soon. So the project is a little safer to invest. So that safety is little bit measured through this one. So one benefit over here is, one major advantage is that if IRR is very higher than existing discount factor of the company, it shows that NPV would not fall down to 0 anytime near future. Hence, investment can be considered safe. So that is one benefit of using the IRR method. What else is good thing about IRR? We're using the same, same thing as told previously. Time value of money is considered because we're taking present value. We're taking the full year as well. So whole useful life is considered. Same as NPV, full useful life and time value of money is considered for IRR calculation. Now we told about the advantages. What about the disadvantage? There is a problem with IRR if cash flows become non-conventional, meaning if one initial investment is negative, then positive came up. If in case again negative comes up, IRR will show multiple results. So for non-conventional cash flow projects, IRR cannot be used as it will show multiple multiple IRR in that case. One more measure is, or one more thing you can say is, because it is not a relative, because it is a relative measure, it does not exactly show which project is going to build shareholder wealth maximization. So you can say that point. Also, as it is a relative measure, IRR will not indicate which project will gain a shareholder wealth maximization. Done. So we told about IRR. Next is about payback period. What does payback period mean? Payback period calculation is about finding the time taken to to get back the initial investment. Now, why is it good to use? What is the advantage of using it? A project that gives, or a project that has low payback period indicates that initial investment will be returned quick and hence break even achieved for the investor, showing that project is less risky because you're going to get the cash flows very soon and the initial investment back, so your break even will reach very quick, so that project is less risky and it is safe to invest in. So this is one good thing about it. What else is a good thing? Same like NPV and IRR, payback period is also based on cash flows and not profits. So we're done with this. What are the negative points of payback period? Number one, if you remember the cash flows, we took 3.17 years to find out that cash flow is coming back in this time. Initial investment is coming back in this time. But we have no idea about what happens after this. Will the project actually give a lot of returns after that? Or will it significantly fall after that? So that's not considered. So unlike the other two, full useful life is not considered for payback period. It's only considered until the point where you hit the break even point. So payback period doesn't consider the doesn't consider the whole useful life, rather only cash flows until break even point. Hence, even if a project is forecasted to return high cash flows in future years, it may be simply ignored because of payback period being long. What else is a problem? We took normal cash flows for calculation. We didn't take the discounted figure, which means time value of money is not considered here. Moreover, time value of money is not considered within a normal payback period. But however, there is an alternate calculation for payback period which is called as discounted cash flows payback period, so that you can state over here. Moreover, time value of money is not considered within a normal payback period, but it can be argued as this is considered within the discounted payback period calculation. So we told about payback period. Last one is about ROC. Compared to other three techniques above, ROCE is a profit based measure. Profits are, first we can say about advantages. Profits are easy to find out as these will be instantly available from financial statements in comparison to obtaining cash flows. So ease of data collection is there. One more thing that is easy is because it's a simple formula to apply, whole calculation is considered. I mean, the it's easy to apply and easy to measure as well. One more thing is because we found out average ROC, we took divided by 4, which means we considered all cash flows for entire year, sorry, all profits for entire year. We took an average and then we found out the ROC, which means the whole useful life is also considered over here. So 2 points to mention. Number 1, it is easy to calculate using a simple formula. And what was the point we mentioned? Easy to calculate using a simple formula, and profits for whole useful life is considered. Now what is negative points about this? Profits are less uh, reliable than cash flows, as profits are subjective to accounting manipulation. 1 point, because when accounting figures change, profits will automatically differ. So accounting manipulation they are subject to. Second point is, though it is though it can be calculated using a simple formula, there are multiple formulas available for ROCE calculation, where under one formula the project may be rejected, while under another formula it may be accepted. This can cause the decision making to be difficult. So now we told about the advantage and disadvantage for all the 4 items, and you can see how we broke down the question into parts. Now don't stop the question over here, because we had second part to this that was asking about advise whether advise the financial feasibility, that is, should we go ahead with the project or not. So advice, or you can say conclusion, whatever you want, you can give it as a title. Advice. Now if I have to give an advice, I have to take the answers over here, copy, paste. 12.55 million, IRR this much, payback this much, average ROC this much. Okay, first we can talk about we can just build the points from here itself. Based on NPV calculated, the based on NPV calculated, it is 12.45 million, indicating that shareholder wealth is created, and as figure is positive, we can, so not we, Nunda Stores can go ahead with the project. Next thing, based on IRR calculation, IRR calculated based on IRR obtained, it is 11.6%, which is slightly higher than the existing discount factor of 10 percentage. Though theoretically, if IRR is greater than existing WACC or existing discount factor, then project is to be accepted. However, since the gap between the figures are very less, this aspect needs to be considered further, or this aspect needs further analysis on it, because the percentage is very small. But as per theory, we have to say that we can go ahead with the project. Then payback period. Based on payback calculation, the time to break even is 3.17 years. There was some target measure given over here. Target measure kept by the company is target payback period is 2.5 years. The time to break even is 3.17 years, which is longer than the company's target of 2.5 years. Hence, this project may not be accepted. Hence, this project may not be accepted. Okay, fine. An average ROC. Based on average ROC obtained, it is 22.3 percentage, and the company's target was at least 25 percentage. It is 22.3 percentage, but 23, which is lower than the company's target rate of 25 percentage. Hence, based on ROCE calculation, project must not be accepted. So if I look at all the four over here, in two of this it is showing a positive sign that you can go ahead and project. Two of it is showing it as a negative sign. You should not go ahead and you should not go ahead with the project. But we need to give a final conclusion, either they should go or they should not go. But if you look at the four methods over here, NPV and IRR is like the strongest investment appraisal techniques based on cash flows, considering whole life, considering the time value of money, where payback and average ROC is like a minimal calculation. Also, if you look at the time period, here it is 1 year longer than the target, not even 1 year, it's like three fourth 75% longer than the original target. And in the other case, it is only marginally less than the target. Plus, all the cash flows and numbers are based on future estimates. In reality, these numbers could be different. So you can give that point over here and give a conclusion that finally it can be accepted. So based on above analysis, under two techniques, project is acceptable, while under other two they are not. However, these indication of not acceptable is only because they are marginally different, marginally not meeting the company targets. It must be noted that all calculations are based on future estimates, and they are subject to fluctuation in reality. Hence, Nunda Stores must proceed with this investment. So this is how we have to break our answer into parts and score all the marks that are there within that particular question. So with this, we are done with 20 marks related to investment appraisal case study number 1. Hope you have followed all the way till here. See you soon in the next video.